Welcome back to the deep dive. Today, we're diving into energy stocks for 2025, especially for anyone out there interested in value investing and passive income.
Right.
And you might be thinking, the S&P 500 is near all-time highs.
Yeah.
Isn't everything crazy expensive right now?
Yeah. You think?
But that's what's kind of interesting, right? There are some energy companies that are offering what seems to be a very rare combination, inexpensive valuations and big, juicy yields.
Yeah, that does seem kind of counterintuitive at first glance.
Yeah.
When you think about it, you think high growth, high price tag, but...
Exactly. And to help us understand this better, we're going to be looking at 3 specific energy companies today.
Oh,
Each one represents a different part of the energy value chain. Upstream, midstream, and downstream.
Okay.
Kind of like we're following a barrel of oil from the moment it's pulled out of the ground all the way to your gas tank. All right, let's start with our upstream play. That is ConocoPhillips, ticker symbol COP.
Okay.
They are in the business of oil exploration and production.
Yeah.
Basically, the folks who find and extract the oil.
Right. ConocoPhillips, they've been making some big moves lately.
Yeah, they have.
They've become the largest U.S.-based independent E&P company.
It's true.
And they've gotten there through a combination of internal investments and acquisitions.
They've been on a bit of a shopping spree.
They have. First, it was Contra Resources back in 2021.
Right.
And then just last year, they completed a merger with Marathon Oil.
Yeah, so 2025 is really a key year for them.
It is.
The first full year with those Marathon assets fully integrated.
That's right.
Now, this is where it gets interesting.
Yeah.
One of the things that makes ConocoPhillips stand out is how resilient they are.
Okay.
Even in the face of fluctuating oil prices, they can generate positive free cash flow, cash they have left over after all the essential expenses, right? Even if oil prices drop to the low $40 a barrel, which is wow.
Yeah, that is pretty impressive.
So they can still be profitable even if oil prices tank.
Yeah, and it gets even better if you don't count their dividend payments. Their break-even point drops even further.
Wow, how low are we talking?
The low $30 a barrel.
That's amazing. They're really in a good spot to handle whatever the energy market throws at them.
They can weather those ups and downs.
I mean, that's peace of mind.
Yeah.
Speaking of peace of mind, let's talk about those dividends.
Okay.
ConocoPhillips, they're currently offering a 3.1% yield.
That's right.
And they're expecting that dividend to grow faster than most of the companies in the S&P 500.
A key point for our listeners, focused on that passive income.
Right.
If you invest $1,000 in ConocoPhillips, you could potentially make about $31 in passive income.
For 2025.
Just for 2025, yeah.
Not too shabby.
Not bad.
What about their valuation? You mentioned that some energy companies are looking pretty inexpensive these days.
Yeah, ConocoPhillips definitely fits that bill. Their PE ratio, that's price to earnings ratio, is 12.1.
Okay.
And their price to free cash flow ratio is 12.9.
Got it.
These are the numbers that value investors are really looking at to figure out if a company's stock price is a good deal compared to their earnings and cash flow.
Right. So it sounds like ConocoPhillips is looking pretty attractive, especially for anyone who thinks oil prices might stay steady or even drop a bit.
Yeah, I'd say so.
Okay, let's move along the energy value chain.
All right.
Let's talk about our midstream player, Kinder Morgan, ticker symbol KMI.
Okay.
If ConocoPhillips is out there finding and extracting the oil, Kinder Morgan is the infrastructure company that gets it to where it needs to go. Pipelines, storage facilities, terminals, all of that.
Right.
The connectors of the energy world.
Yeah, they've got a pretty interesting comeback story.
Well, tell me more.
In 2024, Kinder Morgan's stock price jumped over 50%.
Wow, that's huge.
Big jump.
50%.
It outperformed not just the market, but even the entire energy sector.
So some people might be thinking, oh, I've already missed the boat.
Right.
What do you think caused that rebound?
Well, a couple of things. Their earnings improved, and there was a shift in sentiment towards some of their long-term growth projects.
Okay, but what about the move toward cleaner energy? How does a company like Kinder Morgan, so deeply tied to oil and gas, fit into that future?
Yeah, it's a great question. And a lot of investors are asking that.
Yeah.
The push for clean energy is gaining steam.
It is.
But the demand for oil and natural gas is likely to stay strong.
For how long?
Decades to come.
Wow.
You've got factors like global economic growth and, believe it or not, even AI artificial intelligence.
Interesting.
You need a lot of energy.
Yeah.
That's going to keep those hydrocarbons flowing.
So it's not just as easy as flipping a switch and going fully renewable overnight.
No, definitely not.
Okay. So
That's why companies like Kinder Morgan,
right,
who operate that essential energy infrastructure, still have a part to play.
It sounds like Kinder Morgan's not just sitting back, though, right?
No, they're not.
They're investing in new projects.
Yeah, they've got big projects coming online. And there's potential for even more.
Driven by what?
Rising industrial gas demand, LNG exports to Mexico, even those energy-hungry data centers that power our AI systems.
They're really positioning themselves for growth.
Yeah.
But what about their valuation?
Well,
their stock jumped 50%.
Yeah.
Are they still considered a good deal?
They are, yeah.
Really?
Relatively inexpensive still, I'd say. Their PE ratio is 24.4.
Okay.
Forward PE of 22.
Got it.
Price to free cash flow is 15.7.
Numbers that should get value investors excited.
Yeah.
On top of all that, 4.1% yield.
Right.
So every $1,000 invested, that's about $41 in passive income.
Just this year, yeah.
Not bad at all. All right, let's finish our journey down the energy value chain.
Okay.
Let's look at our downstream play, Phillips 66, ticker symbol PSX.
Got it.
ConocoPhillips finds the oil, Kinder Morgan transports it, Phillips 66 refines it. They take that raw crude and turn it into things like gasoline, jet fuel, all that stuff that keeps our world running.
They play a vital role.
Really do.
Without those downstream companies like Phillips 66, all that crude oil wouldn't do us much good.
It's true. They really are the ones who turn it into the products we need.
Yeah, the finished products, right.
They're like the alchemists of the energy world.
I like that analogy.
But even alchemists face challenges. What's the story with Phillips 66?
Well, it's been a little bit of a roller coaster ride.
Okay.
Back in early 2023, they hit their peak operating margin, and their stock price, well, it went through the roof.
Yeah, that happened.
But then, as things often do in the energy industry,
right,
things took a bit of a downturn. The whole industry kind of dipped. And Phillips 66 saw their margins and earnings drop.
So even though they're a big player,
yeah,
they're not immune to those industry swings.
No, not really. But even with that dip,
yeah,
Phillips 66 is still very profitable.
Okay, good to know.
And their dividend looks pretty strong.
All right, let's talk about those dividends.
Okay.
You know, a lot of our listeners are really interested in those passive income opportunities.
Right.
What's the outlook like for Phillips 66's dividend?
Right. So their current payout is $4.60 per share, and their trailing 12-month earnings are at $7.83.
Okay.
Analysts are predicting about $9.33 per share for 2025.
Wow.
Almost double their dividend obligation.
So they're earning twice what they need to pay out in dividends?
Yeah, basically.
That's reassuring, especially with that 4% yield.
Makes that yield look very sustainable.
Exactly. A $1,000 investment in Phillips 66 could potentially bring in about $40 in passive income for this year.
Yep, for 2025.
Very tempting.
Yeah.
But of course, with any investment, there are risks.
Always.
What are some things our listeners should keep in mind when considering Phillips 66?
Well, like any company in the energy sector, their performance is really tied to the price of oil and gas.
Yeah, that makes sense.
You know, geopolitical events, global supply and demand, even advancements in alternative energy can impact those commodity prices.
And that, of course, affects the profitability of a company like Phillips 66.
Exactly.
So it's not just about the current earnings and dividend yield.
Right.
You got to understand that big picture.
You got it.
The forces that are really shaping the whole energy landscape.
Yeah, it's about understanding the world that these stocks are operating in.
Sometimes that world can be pretty complex.
It can be.
But hey, that's why we're here.
Yeah.
To help you navigate those complexities.
Exactly.
And make more informed decisions.
So we've got three very different companies here.
We do.
Each one with a unique role in the energy value chain.
Right. ConocoPhillips.
Yeah.
The upstream explorer.
Huh?
Kinder Morgan, the midstream infrastructure giant.
The connector.
And Phillips 66, the downstream refining expert.
I'd say we've only scratched the surface of this industry.
Yeah, it seems like it.
What are some key takeaways for our listeners as we move forward?
Well, I think the big one is even in a market that seems overpriced, you can still find value.
That's right.
The energy sector is often overlooked.
It is.
But it offers this really compelling combination of good valuations and solid dividend yields.
And speaking of dividends, they can be a game changer for building passive income streams.
Absolutely.
But we have to remember, investing in energy stocks, like any investment, it has its risks.
For sure.
Their performance is tied to those complex global trends.
Yeah.
And they can be impacted by all kinds of things, from geopolitics to technological innovations in alternative energy.
So it's not just about chasing those high yields.
Right.
You got to do your research and understand the big picture.
Exactly.
Exactly. And on that note, we're going to take a closer look at how these individual companies are navigating those complexities and what their strategies tell us about the future of the energy sector.
Good stuff.
Really fascinating stuff, but we're going to have to take a quick break here.
Okay.
When I come back, we'll dive even deeper into the individual stories of these energy giants.
Looking forward to it.
Stay tuned.
See you in a bit. Welcome back. Before the break, we were talking about how these energy companies are trying to find their place in a world that's moving towards cleaner energy.
It's like they're walking this tightrope between meeting the energy needs we have now and getting ready for a future that's going to look very different.
Yeah, it's a tough balancing act for sure.
And one of the ways they're doing this is by, trying to adapt their strategies and align themselves with, what's known as ESG investing.
ESG. Yeah, it's a big deal these days.
It's everywhere you look.
It is.
And for anyone who might not be familiar, ESG investing, it's about looking at a company's environmental impact, social responsibility, and those governance practices alongside, of course, the financial performance.
It's not just about the bottom line anymore.
Right, and it's really impacting the energy sector.
It is. Investors, especially younger folks, they're demanding that companies really take responsibility for their environmental footprint.
Makes sense.
And show that they're committed to sustainable practices.
So how are our three energy companies responding to this?
Okay.
ConocoPhillips, Kinder Morgan, and Phillips 66.
Yeah.
Are they just, paying lip service to this?
Right.
Or are they actually making changes?
Well, I think each company is doing things their own way, but they all know that ESG isn't just some niche concern.
Right, it's gone mainstream.
It really has.
So let's start with ConocoPhillips.
Okay.
They're the ones pulling the oil out of the ground.
Yeah.
So I imagine they face some unique challenges when it comes to ESG.
They do. Those upstream companies are definitely under the microscope when it comes to their environmental impact.
What are they doing about it?
Well, they're working on reducing their emissions.
Okay.
Investing in carbon capture tech, improving their water management.
So trying to clean up their act, so to speak.
You could say that.
What about Kinder Morgan?
Yeah.
The pipeline company. How does ESG play into that?
It might not seem as obvious, but they're taking it seriously too. They're focused on things like pipeline safety, reducing methane leaks, and working with the communities where they operate.
So it's not just about the oil and gas, but how it's transported.
Right, and the impact on those communities.
Makes sense. And then Phillips 66.
Yeah, the downstream refiner.
They're facing pressure, I imagine.
They are.
To cut those emissions from their refineries and maybe explore some lower carbon fuels.
Exactly. It sounds like they're all trying to adapt and evolve in this changing energy world.
They have to, or they'll lose investors and face those regulations.
Right, it's a smart move, not just a feel-good thing.
So we've talked about their ESG efforts.
Yeah.
But what about their core businesses? What are they doing to stay competitive and grow in the future?
Let's go back to ConocoPhillips.
Okay.
They're focusing on what they call low cost of supply assets.
Low cost of supply? That's interesting. What does that even mean?
So basically, they're choosing oil and gas projects that are relatively cheap to develop and produce. This gives them an edge, especially if oil prices drop.
So they're trying to be the most efficient producer out there.
Yeah, the one that can still make money.
Yeah.
Even when things get tough.
And this all ties back to their focus on generating that free cash flow.
Exactly. They want to keep those dividends flowing and fund new projects, even if the market dips.
Okay, what about Kinder Morgan? How are they planning to grow?
Well, they're banking on the fact that oil and gas demand will stay strong.
We talked about that.
Yeah, they're expanding their pipelines, investing in new infrastructure.
To meet that demand.
Yeah, they're betting on those hydrocarbons.
Even as the world shifts to cleaner energy.
They are. But they're also exploring some other options.
Like?
Renewable natural gas. Carbon dioxide transportation.
So kind of hedging their bets a bit.
Yeah, looking at options that fit into a more sustainable energy system.
And then there's Phillips 66. our downstream refiner.
Right, facing a whole different set of challenges and opportunities.
Refining seems like a tough business right now.
It is, with margins shrinking and the pressure to reduce emissions.
So what are they doing?
Well, they're trying to diversify.
Okay.
Investing in renewable diesel production and exploring things like hydrogen and battery technology.
So they're looking beyond traditional refining.
Yeah, they're thinking about the big picture.
It's amazing how these companies are navigating all of this.
It's a dynamic industry.
But you know, one thing that keeps coming to mind is the idea of risk. Yeah. We talked about oil prices, but what else should investors be thinking about?
Good question. I think beyond those volatile oil prices, you have to consider the regulatory landscape.
Okay.
Governments all over the world are trying to lower carbon emissions.
Yeah, that's true.
And these policies could really impact how profitable these companies are.
So even if they're trying to reduce their emissions,
right,
there's still a chance that regulations could mess things up.
That's always a risk.
And then you've got the technology risk.
Yeah, the energy sector is always changing. New technologies are popping up all the time.
Like those advancements in renewable energy.
Exactly.
And battery storage we were talking about.
If those take off faster than expected,
yeah,
it could disrupt the whole industry.
And these companies could get left behind.
It's possible. Even though they're trying to diversify, it's a reminder that investing is all about balancing those potential rewards with the risks.
Speaking of rewards, let's get back to those dividends. They've been a big part of our conversation.
They have.
And for good reason.
For sure.
Passive income is a powerful tool for investors.
It is.
And these energy companies are offering some pretty sweet yields.
They are, but
we got to look beyond just the yield.
Right. It's about sustainability.
A high yield doesn't mean much if the company can't keep paying it.
Exactly.
So let's check out the dividend track records.
Okay.
See how our three companies measure up.
Let's start with ConocoPhillips.
Okay.
They've got a long history of paying dividends, and they've been steadily increasing them over the past few years.
That's a good sign. Shows commitment.
Yeah, they want to reward their shareholders.
And they think they can generate the cash flow to keep it up.
And remember, they have that low cost of supply strategy.
Right, helps them stay profitable.
Even when oil prices are down.
Okay, what about Kinder Morgan? How's their track record?
A little bit mixed.
Okay.
They had to cut their dividend back in 2015.
Ouch. Dividend cuts are never good.
No. Not for investor confidence, but to their credit, they've been increasing it steadily ever since. They're really committed to that dividend growth.
Trying to rebuild that trust to show they've learned from the past.
And their recent performance, along with those growth projects, suggests they're on the right path.
Okay, good to hear. And Phillips, 66. How do they stack up?
Solid track record. Consistently increasing their dividend for over a decade.
Wow.
Strong financial position, too.
That's great.
They've even been buying back their own shares.
Another way to return value to shareholders.
Exactly.
So all three companies are paying dividends.
Yeah.
They all seem pretty committed to rewarding their shareholders.
They do.
But like we said, no investment is risk-free. That's why it's so important to really do your research.
Right.
Understand the companies, their strategies, the risks, the potential.
And that's where we come in, right?
That's right. We're here to help you make those informed decisions.
To become smarter, more confident investors.
And part of that is realizing that the energy sector is always changing.
It really is.
It's not just about oil prices anymore. It's about navigating this whole complex web of geopolitics, technology regulations, and even consumer demand.
There's a lot to keep track of.
And right at the heart of it all are these companies, ConocoPhillips, Kinder Morgan, Phillips 66.
Trying to figure out where they fit.
In a world that wants cleaner, more sustainable energy.
It's a fascinating story.
It really is.
And that's what makes this deep dive so interesting. It's not just about the numbers. It's about understanding the forces shaping the future of energy.
And the role that these companies will play.
A story with many chapters left to be written.
We can't wait to see how it all plays out.
But for now, let's take a moment. Reflect on what we've learned.
We looked at the different parts of the energy value chain, explored that ESG landscape, and dug into those dividend track records.
And we've only scratched the surface.
There's so much more to uncover.
We'll have to save it for the next part of our deep dives.
Welcome back to the deep dive. You know, this whole journey into energy stocks has really opened my eyes. There's so much happening behind the scenes.
It's easy to just focus on those headlines about clean energy.
Right, electric vehicles.
And think, oh, oil and gas are done.
Like they're going extinct.
But as we've been talking about, it's way more complicated than that.
So much more nuance.
Oil and gas are still a huge part of our lives.
They are, and they'll be around for a while.
Decades, probably.
So the question is, how do you make sense of it all as an investor?
That's the question, isn't it? And honestly, there's no simple answer.
Right.
But I think one of the most important things is to zoom out and look at the global picture.
Okay, let's do that.
What are the big things happening in the world that are impacting the energy landscape? Well, one of the biggest is the growing energy demand, especially in those emerging markets.
You're right.
China, India.
Right. Makes sense.
As they develop, their need for energy is going to go way up.
More people, more industry, it all adds up.
Exactly, and renewable energy is growing fast.
It is.
But it can't keep up with that demand.
So oil and gas are still essential.
For now, yeah, it's a gradual shift.
Not a sudden switch.
Which puts companies like ConocoPhillips, Kinder Morgan, Phillips 66 in a really interesting position. They have to balance today's energy needs with getting ready for a lower carbon future.
Like walking that tightrope again?
It is. They're kind of the bridge builders.
I like it.
Between the old and the new.
Connecting those energy systems.
But it's tough.
Yeah.
Making decisions today that will set them up for a future that's still uncertain.
High stakes.
It is. But one thing that's been on my mind is diversification.
Right.
We've been talking about these three companies.
We have.
But there are so many energy stocks out there.
It's a whole universe.
And diversification is key for any good investor.
It is. Helps you manage that risk.
And potentially get better returns.
So if you're thinking about adding some energy to your portfolio, you got to consider those different parts of the value chain.
Upstream, midstream, downstream.
And don't put all your eggs in one basket.
Spread it around different companies.
And different types of energy stocks too, right?
Absolutely. Exploration companies, pipeline companies, refiners.
Service companies.
Even renewable energy companies.
That's a lot to take in.
It is, but that's what makes it interesting.
Always something new to learn.
That's what we're all about here on The Deep Dive.
Right, helping you dig deeper.
Become more informed investors.
Now, I want to leave you with something to think about. We've talked about the companies, the numbers, the trends, the risks.
Hey, that's a lot.
But at the end of the day, investing is about more than just those numbers.
It is.
It's about understanding the world.
And how it's all connected.
Exactly. How those forces are shaping the future.
That's what makes investing so fascinating.
It really is.
It's not just picking stocks.
Right.
It's understanding those stories behind them.
People.
The tech, the challenges.
The successes, the failures.
And in energy, those stories are really captivating right now.
We're seeing this huge change.
Right, how we get our energy.
How we use it, how we think about it.
And those companies that can adapt.
Yeah.
The ones that can balance the needs of today with the demands of tomorrow.
Those are the ones that will thrive.
So as you continue on your investing journey, stay curious.
Stay informed.
And most importantly, stay engaged.
It's a dynamic world out there.
Full of surprises.
Who knows what the next big opportunity will be?
And we'll be here to help you navigate it all.
Thanks for joining us on The Deep Dive.